Hey, good morning, everybody. Want to welcome you to today's event. It is Saturday, March 29th. We're going to get into the market. Is this a bear market correction? A bear market or a correction? What do we got going on here? We got a great crowd here today. And boy, just couldn't be the timing couldn't be much better considering how we ended the week. And it's pretty amazing when you stop and think about the market's pretty much where it was the middle of last year. And now the question is what might be happening next. Anyway, it's great to have all of you with us. We have a lot of new faces here today. We have a lot of great members. A lot of you are new to Earnings Beats. We've been in business since 2004. So we're into our 21st year. And we believe it or not, we've got actual people, members who've been with us since we started. So we really, really appreciate their support. Anyways, I do want to, remind everybody you get a copy of this recording today and a couple of other quick things. Not going to really be a big Q&A session today. That'll be reserved for Monday. Tom will get into that later. We got a big event for members, our annual members actually, coming up on Monday, where Tom will be doing a total update, quarterly update. We do 4 of those a year, plus we have our big event each year, our Market Vision event. Tom will talk about that a little bit more. So really not much Q&A today. This is about education. And I know there's a lot to cover, so let's make sure Mr. Bowley's in the house. How's it going, Tom?
It's going great. How you doing, John?
Hello, everybody. I'm feeling pretty good because I finally got a team in the Elite Eight, Michigan State. They finally got there. Been a while, but anyway, so that's kind of fun. Yeah, Michigan didn't make it. Maryland fell short, but you got to take what you can get. Anyways, what's that?
I said absolutely. Take what you can get. Same thing with the market.
Yeah, I mean, anyways, this has been a really interesting period of time. A lot of people are very nervous about what's happening out there. So I know you have a lot to cover. I'll be in the background here. If you need anything, just let me know.
All right. Sounds good. Yeah, this has been a really interesting quarter for everybody. I saw a comment in the area, and leave some comments. One thing is kind of cool, and we've done this before. If you want to give out information, just let us know where you're from, in the comments, because we do have a global business. We got folks from all over the world. Be interesting to see where everybody's from. So that would be great to let us know. I can tell you I'm coming from broadcasting here from northern part of South Carolina. I'm just a little bit south of Charlotte, North Carolina. John also is in South Carolina. He's in the Charleston area. So be great to hear where everybody is from. So go ahead and share that if you don't mind. As far as the market goes, the one thing I guess that maybe we do that maybe is a little bit different or better, or however you want to put it, versus a lot of others that have similar type services, is I really think that we pay a lot of attention to perspective, long-term perspective, and just common sense, and not getting tied up every single day in every news event and every CNBC article or comment or show. And these types of events for me are really useful, not just for education purposes, but for me personally, to take the time to go back to review all my charts, to really get a good sense of everything that's taken place in the market, and then kind of get a sense of, when you put it all together, it's kind of like a 1,000-piece puzzle. Sometimes you want to just cling to those 2 pieces of the puzzle, that you just heard on the news last night or whatever, but it's really a big puzzle that comes together. And, going through and looking at all these charts and sharing them with folks like all of you really helps me kind of gather my own perspective on where things are going. And I think it really helps us to call the market. I'm not one to really, well, maybe I am one to toot my own horn sometimes, but I think that's probably normal. But I do think we have an uncanny ability at Earnings Beats to forecast the market going out further. I think day to day is so hard Every once in a while I'll say, well, I think we're ready for a downturn. The market goes up and I'll get comments saying, oh, good call. I don't know what's going to happen from day to day. I think that's really, really hard to predict. And it's a gamble from day to day. I do think, however, when you step back and you look at some of the big picture and just get an understanding of the story that the stock market's telling us, forget about the story that the media is telling us. You have to understand that one of the biggest conflicts that I am aware of in my entire world and life is that you've got, with the stock market, with these big Wall Street firms, you have firms that not only are managing their own money and their wealthy clients' money, but then they're going on to CNBC and other media outlets and they're telling you what you should be doing a lot of times after the fact. I love these stocks that go from 200 to 100. Then somebody comes on and says, we're going to lower our target down to 95 when it was at 200. How about lowering it at 95 when it was at 200 instead of waiting? But I just find a lot of the information of these analysts and so forth that come onto CNBC, and I call them influencers, by the way. I don't call them analysts. I call them influencers because all they're trying to do is to influence, in my opinion, the market going one direction or the other. Yes, some of them are better than others. Yes, some of them have great calls. But I think overall, to me, that's what's going on. So you've got Wall Street, these big firms managing their own money and their wealthy clients' money. Then you've got their influencers going on to CNBC and other media outlets telling us what we should be doing. And then they got a market making unit back home, basically saying that, or basically taking positions opposite of everyone else. So tell me where that isn't a conflict of interest. I mean, you got all sides covered. And so no wonder these big Wall Street firms can make so much money. So, but the beauty of it is if you follow the charts, not the words, don't watch the lips moving on CNBC, watch the prices moving on the charts and the rotation. That's what helps you get a better picture of what's going on in the market. And I know a lot of you, probably want to talk politics and it's this, it's the Republicans, it's the Democrats. I don't get into that. You know what? You're Republican, vote your conscience. If you're Democrat, vote your conscience. I don't care. And I don't talk about it. I mean, I've been doing these shows for years and years, been writing at stock charts for years. I dare anyone to go in and take a look and find any of my work that talks about Bush, Obama, Trump, Biden, and now Trump again. I don't talk about it. I've done research and there's not really a whole lot of difference between different political parties being in charge. The one thing that from a political standpoint that I always say, one thing that can affect the market negatively, at least somewhat, is when one party is in charge of everything, because then you start to get a skewing more toward one side or the other, and you don't stay in the middle, which is where everybody benefits or the majority benefits. So that's the only thing that I'm going to say about politics. I don't like to talk about politics. If you want to bring up politics in comments, that's up to you, but I'm not going to respond to them. Anyhow, so what I want to go over today, I really just want to share some of the research that I've done here just over the past few days. I was still doing more research this morning, going through and trying to give, looking at every, around every corner. I'm trying to find anything I could to help everybody as we try to move, into the second quarter. And one of the comments talking about, glad the first quarter is behind us. I completely agree. And we talked about this at Market Vision 2025. First Saturday in January, I said this was going to be a challenging quarter and that we could see a 10% correction. And S&P 500 lost 10.43% from top to bottom. From the all-time high in February down to the bottom, we lost 10%. So I think, so far, this has kind of started off exactly the way I expected it would. I think, again, some of you may look politically at it, but I look at the Fed. I don't care whether it's Republican or Democrat in the White House. The Fed has certain responsibilities. They have certain mandates. And part of their mandate is looking to see what's the fiscal policy. So I think it's all baked into the charts. And, it's not like Wall Street doesn't know what's going on politically. They're still betting their money. So if you follow the charts, you should be following the entire story of what's going on. So it's not like you can say, well, someone did this or somebody's about to do this. And you think Wall Street doesn't know that some of that stuff's about to happen? It's all priced in. That's the beauty of technical analysis. That's the beauty of, getting up every day and having new challenges in the market. So with that, let me go ahead and get started and take a look at some charts for you. I almost always start with this chart because this gives us the grandest perspective of all. This is a 100-year chart, monthly chart of the S&P 500, and I think it clearly reflects the different super cycles that we go through in the market. You've got your secular bear market in the 20s, late 20s, early 30s, and throughout the 40s. You got your secular bear market in the 1970s into the early 80s, starting with the dot-com bubble in year 2000. That started another secular bear market, dot-com bubble, followed by the financial crisis. But notice the pattern during a secular bear market. We go up, we go down. There's pockets of strength, certainly a lot of pockets of weakness, and sometimes very deep pockets of weakness in a secular bear market. But overall, it's just a long period of time where you just don't go anywhere. You go up and down. Usually you go up, market starts going up, everybody gets excited and they start getting in more and more and more. And then the bottom drops out. And then you swear you're never going to get in the market again. That's a secular bear market. Secular bull markets are periods when we actually are in a trend for an extended period of time, many, many, many years. And there's so many problems that come up during those periods, and it doesn't matter. The market keeps going up. 1960s, 1950s, 1960s, 20 years of going up. 1980s, 1990s, 20 years of going up. We broke out of this top. And notice when I start the bull market, it's always when we break out of the prior highs. This one actually started when we broke out of this double top. Because, back in 1929, before the crash, prices were at a peak. We had no Fed. It was just chaos financially. I wasn't there, fortunately, because if I'd been there, I probably wouldn't be here. But, that was a period that really we can't relate to any other because there was just no monitoring. There was no auditing. There was just no one there, to really follow and be the watchdog. So we had the SEC come on board and, I guess, 1933, 1934, whatever. And so markets began more regulation and so forth. And so it became a little bit easier, I think. Anyway, all of that just to say we broke out above this double top in 1950 and notice we went up for 20 years. We broke above basically double top, not quite a double top. Really, that 1973 peak was probably the only key high. But we took that out in 1980 and started a 20-year period. In 2000 and 2007, both those tops were around 1550. I think the second one might have been just slightly higher. But you can kind of see the sideways, long-term sideways. It doesn't look like a whole lot on this chart. This is 12, 13 years. Secular bear markets are no fun. You don't really create a lot of wealth during those periods. So you better create it when you're in a secular bull market, which is what we're in right now. And again, everybody can say whatever they want about what's going on currently, whether it's economy, whether it's interest rates, whether it's politics, I don't care. Basically, it's all included in the price, and the price continues to go higher. We are in a secular bull market. It doesn't mean we don't have corrections. It doesn't mean we don't have cyclical bear markets. We had one of those in 2022, which we called at the beginning of 2022 at our Market Vision 2022 event. We said at the time, the S&P 500 could go down 20 to 25% over the next 6 to 9 months. Actually, I might have said over the 3 to 6 months. I thought we were just poised for it, and I'll show you why in just a minute. Well, there are a lot of reasons why, but I'll show you one of them in just a minute. And so we had, and there it is. You can see it right there on the chart coming down. It doesn't look bad in hindsight because, again, we're looking at a 100-year chart. This is perspective. You can have pullbacks. You can have really deep sell-offs. The NASDAQ went down 38% in 2022. The S&P, I think, bottomed around 28% down. Those are some of the biggest drops we've ever seen in secular bull markets. But we rallied back off of it, and the uptrend remains intact. And I said during the 2022 bear market, we're going back to all-time highs. Called a bottom in June of 2022, and we went up 700 points on the S&P 500 over the next 2 months. And then my buddy, the Fed, Fed Chief Powell stepped in, said more pain ahead on August 26th, 2022, and the market tanked. Went down just slightly below the June low, and then we took off. So again, perspective, keeping everything in perspective is really important. And hopefully this chart, I show it every week to our members at Earnings Beats in our weekly market report, because I think it's that important. You've got to keep perspective in mind and don't get caught up in every news story. I mean, if you want to go and talk, at your local bar or whatever with your friends about what's going on, that's fine. But when you're managing your money, you've got to put that stuff to the side. You've got to follow the charts. All right, let's take a look at, I'm going to go in and just show you some channels. These are some of the charts I showed back at Market Vision 2025, just a few months ago. But one thing when you go through these periods, now this goes back to 2009. So this was the financial crisis bottom. And since then, that was a panicked low. I think everybody can agree that was a panicked low. Well, 2020, when we had the pandemic, I think most everybody could agree that was a panicked low. I mean, we went down, 30% or whatever, 35% in less than a month. Yeah, everybody was panicking. I don't know anybody that wasn't panicking. But even during that, I said it's a healthcare crisis, not a financial crisis, and we would return back up. This was going to be short-lived, and that's what it was, right back up. And part of what's helped me is just knowing that we are in a secular bull market. And so the market just wants to go higher. It's going to pull back from time to time. This is how Wall Street, the whole greedy bunch on Wall Street, this is how they make money. They get out the top. They let things come back down a little bit. They scare the heck out of folks in the media. And then folks start selling when prices drop too far. They start looking at how much money they're losing and they just can't take it. And they get out. And guess what? That's when market makers are buying for their institutional clients. That's what they do. So you got to be a step ahead of them. One way to be a step ahead of them is simply to follow the channel, because every single time we get up in the upper end of this channel, and the way I establish the tops is by first connecting the panicked lows and then dragging that and connecting as many highs as I can. And so essentially you can see back in 2011, we hit the top of the channel, fell back. 2015, actually after about a year of just riding the top of the channel, we fell back. 2018, hit the top of the channel, fell back. Look at this, 2021. And this was what I was saying. This is one of the reasons why I felt like this market, the risks of being long going into 2022 were crazy because we had broken outside the channel. It's just not normal. In a channel, essentially what you're going to do is you're going to average better than normal returns. It doesn't mean you're just going to go, take off to the moon, every year go up 50%. That's not going to happen. And when you start having years like that, then you've got to keep perspective and realize that over the last 100 years, or over the last 75 years anyway, the S&P 500 is average going up 9% a year. So if you get a couple of years like we did, look from this bottom at 2000 to this high at the beginning of 2022, we went up 115% less than 2 years. That's a little more than 9% a year, I would say. So you get outside that and it's like, we're coming back down. Sentiment, everybody was buying. Remember the meme stocks? They were just, it's kind of like .com bubble. Whenever you get to these major tops, it's like valuations on some stocks that make no sense go crazy. And this was back when a lot of new folks were trading because of the pandemic, stay at home. You got a lot of money coming into the market. And guess what market makers are doing? They're licking their chops. They got a whole new set of folks they can steal money from. Legal, not going to go to jail for it. But as far as I'm concerned, it's stealing money, the way that the game is played. But you either learn to play the game or you lose your money. Anyhow, here, coming out of this channel, look at that drop. Notice that in June, or right around in June, we came down and we hit this middle line. So we got the upper line, we got the lower line, and we got the middle line. And for the most part, except for these massive, crazy panicked lows, notice that we've been holding pretty much that middle. That's when, if we have a cyclical bear market, we tend to get down to that center line, and then that's about it. We go a little bit below, but I think you can argue over the last 16 years, that if you get back down to that middle line, it's generally the time you want to be getting into the market. I mean, I think it's been proven over and over and over again. But we started this year, 2025, right at the top of the channel. Now, I said back at the beginning of the year, it might be something like this, like 2014, where we just hugged the top of the channel. But there were too many other signals that suggest we were going to come down. And so that was why we were starting to talk about maybe this 10% correction. Now, we've already hit it. Are we going to stop there? Are we going to keep going lower? We'll talk more about that as we go through today, and then, of course, on Monday as well. But yeah, this is one thing we definitely need to watch. Anytime we get near the top of these channels, it's no different than in a stock. When a stock goes up in a channel, get up to the upper end of the channel, it's time to maybe think about taking some profits and waiting on a pullback. The overall market, no different. How about the NASDAQ 15-year channel? Actually, before I go to the NASDAQ, let's go back to the other chart because I didn't go to the bottom here. One thing I wanted to mention, I've got down here at the bottom, this is a 52. Remember, this is a weekly chart. So this is a rate of change 52. That means it's a 52-week rate of change on the S&P 500. So that's what this is following. It's just always giving us where we are versus where we were a year ago. And so right now, the S&P 500 is up 6% from where we were a year ago. Now, notice when we get down to bottoms, key bottoms, a lot of times, we will see this 1 year rate of change move below zero. We're still above zero. We're still at 6.22. So we're not quite down to where the rate of change would start to maybe tell us we got to be thinking maybe outside the box and not getting caught up in all the negativity. That's the worst thing in the world, is to get sucked into all that negativity. And when it's outrageous complacency, you don't want to be in either one. So sentiment, it plays a big role in the direction of the market. But anyway, right now, I think, we're kind of in the middle. We certainly historically have shown we can go a lot lower than where we are right now. So I think this would point to at least the possibility that this downtrend continues for a little while. Here's the 26-week. So this is a half year rate of change. We just went negative. So we're now down 2.74% on the S&P 500 over the last 6 months. And if you look at bottoms, I mean, this was a bottom that occurred right when we got down to about minus 20. That's a bear market. That's a bear market over 6 months. So it doesn't happen often during a bull market. Remember, we're in a secular bull market. So since 2013, when we broke out, all of these moves down, we've had a couple of bear markets. This one here at the end of 2018 doesn't show exactly a bear market, and that's because when you look back, the top and the bottom were not exactly 90 days apart. 180 days apart, 6 months apart. So that's why you're not going to see minus 20% here, because we were never 20% down from the previous 6 months, from 6 months earlier. So, and this whole bear market occurred just in the last quarter. So when you go to the quarter down here, you'll see that we got very close to minus 20% in 2018. And again, I think the bottom in 2018 may have been like right around Christmas. So I think it was like the 26th. I'd have to go back and double check that, but I think that was the low. And the high was in October, early October. So that's why, again, 30 days is not going to get us to minus, back here. 30 days is not going to get us, or not 30, this is quarterly, sorry. 90 days. When we look back, 90-day rate of change, we're not going to see minus 20% because we never had that 20% exactly 90 days apart. But again, look at where we are right now. We're minus 6.53% over the last quarter. That's, starting to get down there during secular bull markets. I mean, it's time to at least be thinking that bottom, is either in or maybe could be in pretty soon, just based on history. Now, again, we did have some of these that went down. That was the pandemic. Obviously, all the way back down in 2008, that was the financial crisis. But we had the cyclical bear market in 2022, where we got down here to almost minus 20. Then we had the same thing in the trade war, 2018. And then 2016, a little bit more. That was correction, not a cyclical bear market. But anyhow, again, all I'm doing here is just using perspective. I'm just seeing how we stand now versus other key bottoms. just to get an idea of how close we're getting. I can tell you one thing, I'd certainly rather buy the stock market when we're down here on these rate of changes than we're way up here, like at 20, 25% at where we've gone up that much over the course of a half a year, because it's normally not sustainable. We know that 9% is a normal year. So if you get 25% in 6 months, some point you're probably going to start to pull back in the other direction. All right, keep moving. NASDAQ 100. Now, since I did a lot of explaining on the last chart, I'm not going to spend a whole lot of time here. But again, we basically have a channel. The channel is going up at a faster rate. NASDAQ tends to move up much faster. Earnings on NASDAQ stocks tend to grow much faster than the overall S&P 500 because you got a lot of value stocks. You got a lot of defensive stocks. Things stocks that don't really grow their earnings very fast. Most of the companies in the NASDAQ are high growers. So when we get into a bull market, you're generally going to see the NASDAQ do better. You're going to see the slope of the lines a little bit, more to the upside. And so when the market's strong, this is usually the index you want to be in, QQQ, as opposed to the spider, SPY. But during pullbacks, it's just the opposite. If you're going to be in one or the other, generally it's better to be in the spider because you have more defensive stocks in other areas of the market that can help offset some of the growth stocks. Hopefully that makes sense. I'm not going to go down here, but you can see again, rate of changes. We've gone negative on the half year rate of change here. And you can see all these blue directional lines. When we bottomed here, I put in the horizontal blue dotted line, or excuse me, the vertical blue dotted line. And you can see, look at where these come in at. They come in at periods when you want to buy. Here we went down just a little bit more. That was the cyclical bear market, 2022. But again, that was probably pretty close to where I called the bottom, somewhere right around in there, before we ended up coming back down one more time. So when we get this, we're going into negative territory. If you happen to notice over the next month or two, this really starting to creep down, getting past -10. I mean, that could be, you don't see too many that go down below -10 on a 6-month basis during a secular bull market. So again, just perspective. That's all we're talking about here. Forget about the news. Let your mind relax for a little bit. Let's just talk about price. IWM, here was the channel of the IWM. And by the way, I'm talking about some of the calls we've made at the beginning of the year have been great. We don't make all great calls. I thought 2025 and 2024 were going to be years when the IWM small caps really started to take off. And we kind of got that a little bit toward the end of 2024. Second half of 2024, once the Fed announced basically they're going to lower rates. Actually, Wall Street was anticipating. So we saw a lot of outperformance in small caps before the rate cuts. And then once the rate cuts came in, we held on to a lot of those relative gains in small caps. And then as soon as the Fed said, well, now we don't know if we're going to cut 4 times in 2025, may only be 2. And then the next meeting, they said, well, we're pausing. And now they're back to talking about still cutting 2 times. I'm not exactly sure where they are. But the small caps, and one of the things I said was it is dependent on rates coming down. That's what I see. I see rates coming down and the IWM having a great period during those rate cuts. It started, like I said, we went to an all-time high in the second half of 2025 or 2024. But as soon as the Fed pulled the carpet out from under us, you can see what's has happened. Now, I still am going to say the same thing. When the Fed decides it's back on the interest rate cutting kick, I think you're going to see the IWM take back off again to the upside. All right, let's keep moving along here. So let's take a look at sectors. So those were the major indices. So let's take a look at the sectors. And there's some really interesting differences between now and the cyclical bear market of 2022. And I think this is where you're going to see it. So first off, yes, technology, largest area of the S&P 500 and of the NASDAQ 100. Technology is one of the weakest areas in the market. And that's what is driving the market lower, along with discretionary stocks. But here's technology. So I've got a couple key areas of support that I've lined up there, maybe around 176, something like that. Another one around 190. Right now we're at 206. Could we go down to one or both of those? It's possible. In fact, I wouldn't Wouldn't be surprised. I wouldn't be shocked to see 190. I'd probably be a little bit more surprised to see, in the 170s. But, we still got potentially more panicked days ahead, maybe. For technology to go down $16, that's about 8% from where we are right now. That doesn't mean the market goes down 8%. Money can rotate in some other areas, and market may only go down 5%, 4% from here. Technology may just be the leader in driving it lower, which would be normal. That's what we normally see. And then down below, you can see on a relative basis, technology peaked all the way back in June, July of last year. Remember semiconductors peaking? Wrote articles about it and said, be careful with semiconductors until they break out again. They haven't broken out. And so here we are, technology still struggling. But we'll reach a bottom. And when we reach the bottom, that is going to be one of the times you're going to want to be in technology, and you're going to want to be in semiconductors. Like I said, almost a year ago, everybody loved semiconductors. They'd pull back, 1%. Everybody's ready to jump in. Now it's like, whoa, nobody wants to touch semiconductors. They're kind of broken. Well, that's generally the time you want to think about getting in. So we'll probably have a pretty good buying opportunity, I would say, later in 2025 into some of these key aggressive areas. So that's technology. Here's discretionary. Discretionary topped in December. These are growth areas. Remember, the market didn't top until February 19th. That was the S&P 500's high, right? All-time high, February 19th close. That's not the case, though, with technology and discretionary. They topped sooner. Why were folks getting out of growth? Well, I doubt that there were a whole lot of those influencers from Wall Street on CNBC telling everybody to get out. But on the charts, we can see exactly what they were doing. They were getting out. They were moving away from, and this is when I started getting bearish, and I started saying, hey, we could be in for a correction. You start seeing money go out of aggressive areas and into defensive areas, and that's first thing comes to my mind. Well, if Wall Street, if it's going to be a little blip to the downside and we're just going to go right back up, down 2, 3, 4%, you're not going to see a mass exodus out of, from Wall Street. You're going to see major, huge drops in technology and discretionary. It'll be very temporary. They got millions and millions of shares they buy and sell. They can't really be getting out and back in 3 days later. When they're getting out of these areas, it generally means we got problems ahead. Until the market proves to us otherwise, that's the mindset you should have. So that's what we were talking about going into the beginning of the year. And then as the year unfolded, it got a lot worse. Let's keep going here. Now, communication services. So you got tops here all the way back 2021, and then a little top there in 2024. And then we broke out and we haven't gone back. So these are a couple levels I'd watch. We're now back below the 20-week moving average, and we've been there now for 3 weeks in a row. And if you look back during this bull market run, that had not happened. Not since the bottom in 2022. We went down briefly below the 20-week moving average, but we haven't stayed there. Right now we're staying there, and look at where we closed pretty weak on Friday. So again, you're looking at the three most aggressive groups, and they're not looking very good. Look at XLC, look at the PPO, lower PPO, higher price, negative divergence. I look for a 50-period test. 50-period test down near 90, which isn't far from the support level, which looks like probably around 88, 87, 88. So yeah, again, XLC goes down $6, $7, $8. It's not going to really mean that much in the big picture, but it would unwind this negative divergence, and it certainly would add some more, perhaps some acceleration of selling in the near term. Then you go into industrials. So industrial still holding up pretty well, sitting on its 50-week moving average. So it's still in an uptrend. I'm fine. And then you look at financials. Financials are even better. Financials now have bounced back up. They were trying to go back through their 20-week moving average. Look at the relative strength of financials. I can tell you that's not generally what you would see if you were worried about inflation. It's just not going to be what works during an inflationary period, because what's the Fed going to do during an inflationary period? They're going to raise those short-term rates. The Fed funds rate is going to get raised. And so what's going to happen to the banks? What's going to happen to their net interest margins? Short term, that's what they use. They borrow with the short term and then they earn with the long term. So the difference, that spread, is what makes a bank make money. And so if you got inflation, you're going to be raising the short-term rates. So banks, if you're worried about inflation, should not be seeing banks doing this. So just one of those signals to me that just tells me that all this talk and all the rhetoric about inflation, that's not where the money is. The money's not worried about inflation. The money is worried about economic issues. And again, the Fed has two mandates. They can go after inflation, price stabilization, or they can go after the economy, which is employment, labor force, increasing jobs. They can do one or the other. They lower rates to help spur the economy. They raise rates to either, slow down the economy, or they can raise rates to fight inflation. When inflation's not a problem, you can lower rates. Gives them the ability to lower rates to worry more about the economy. So right now, or recently, they've been picking their fight. Their fight's been inflation. That's what they're talking about. And since they've been talking about inflation, we've seen the market make a massive turn back to the downside because Wall Street's saying it's not about inflation, Fed. It's about the economy. And if you leave rates too high, while Europe, Germany, they're lowering rates, German economy is going to pick up. Our economy is not. The dollar's reflecting that. The dollar's going down. I mean, to me, the charts are giving us a pretty strong story, and it's the economy. It's not inflation. Can't say that any more strongly. I've been saying it and saying it and saying it. It's not inflation. Hear it on the news, great. And some will say, well, what about tariffs? Okay, we had tariffs in 2018. Did we have a huge inflation problem? We had a bear market. Did we have inflation? I don't remember it. The thing with tariffs, from a common sense perspective, tariffs raise prices one time. If you have a 10% tariff, prices go up 10% for that one time. What happens the next month? You still have a 10% tariff. And that's what inflation looks at. It looks at month-to-month increments. I don't understand all the talk about tariffs and huge inflation. It will be temporary if you have any. Like I said, 2018, I never really saw any kind of a major blip in inflation. We had tariffs. What's different? All right. Let's go on to healthcare. So here you got healthcare. You got, oh my gosh, look at all these tops coming across around 135, bottoms 135. I mean, healthcare is still fine. And look at what's going on, by the way, in 2025. While technology, discretionary, communication services, industrials, all kind of moved down, healthcare going up. Staples going up. Staples recently just set an all-time high in March. Now, we saw that back in 2022 initially, but before it ended, we saw Staples going down to new lows. If you go back down, go to the healthcare, we're still kind of in this uptrend. 2022 during the bear markets, everything goes down. You don't escape bear markets without pretty much all areas of the market going down, obviously some more than others. What I'm seeing right now is, yes, technology is getting beaten up. Discretionary is getting beaten up. Communication services to a lesser degree. Industrials have gotten beaten up, even though I think they've stabilized now. Financials have held up probably better than any of the other groups that are what I consider to be more aggressive groups. But money right now is still rotating into defensive areas. We're not seeing breakdowns yet. We're not seeing lower lows. Staples, where do you see any lower lows? I don't see any lower lows. I mean, for the most part, we had a little bit of a lower low in December, I guess, below this low. But since the market's really started to turn south, we've actually gone up, put in new highs on Staples. Real estate held on to support beginning of the year. We've been rising. Utilities up still near all-time highs. Materials hasn't broken down, still holding on to that end of the year low. And energy, I think, could look best of all. And the fact that we're getting signs of a global economic recovery, And I'll talk a little bit about that on Monday. That's going to be one of the keys to Mondays. We've got a global economic recovery that I think is underway. And I don't know that there's going to be too many areas that are going to benefit from that more than energy. So watch this one. We're right near an all-time high. There's reason to believe that it's going to break out. All right. Let me move on to, let's see if there was one other thing I wanted to do here. Yeah, let's talk a little bit about seasonality now. So the next few months, of course, May's coming up. Go away in May, right? Isn't that what the media tells us all the time? Well, during this secular bull market that started in 2013, so if you look here, what I've done is these are the percentage of months in which S&P has closed higher than it opened from 2013 to 2025. This is during the secular bull market. And we come down here and look at April's gone up 83% of the months since 2013. May, you really want to go away in May? 92% of May's have been higher. 75% of June's have been higher. 92% of July's have been higher. So, yeah, it rhymes. It sounds great. Go away in May. They probably would love for you to go away. Sell your stock. They'll gladly take your shares. April through July has been as solid as any other time of the year. More solid when you look at a 3-4 month period. I mean, November has been a great month, but the months around it, October's been good, December flat. But these are 4 consecutive months where the S&P during this secular bull market has averaged going up at least 1%. Folks, it's March 29th. So seasonally in this secular bull market, the next 4 months have been really good. Now, again, is seasonality my primary indicator? No, it's secondary. My primary indicator is price and price alone, well, along with volume. Price and volume. Number one, nothing else is close. If you're downtrending, you're losing money if you're long. If you're uptrending, you're making money. We can talk about all these other signals and everything else all you want, but if price action's going down, take all those secondary indicators, put them together, throw in $10 and go get yourself a meal at, extra value or whatever meal at McDonald's. You can see how often I go to McDonald's. Is it the extra value meal? Anyway, but secondary indicators are really important when they line up together, because then you start to look for things in price to reverse. And if all the secondary signals are strong enough, then you've got to look at this as maybe not calling the exact bottom, but you've got to look at it as a risk. That's what I always talk about. I think we've been really good at calling tops and bottoms, but that's not the purpose of why I say the market's topping or the market's bottoming. The purpose is that the risks have shifted. So you go down in a bear market, you're down 25%. I mean, historically, not too many bear markets have gone down much more than 25%. The odds are really starting to turn against the bears, and yet they think they're going to take it to zero. It's not going to happen. And in most secular bull markets, those cyclical bear markets, the short-term bear markets, when you get down more than 20%, you should start putting your money back into the market. Yeah, you might lose a little bit more for a period of time, but you don't know if you're going to be able to call the exact bottom. And if you go from minus 20% all the way back to the high and you watched it, you're going to be kicking yourself. You didn't get into at least something back when it was down 20%. So that's just common sense to me. Perspective. Once you've gone down a lot, there's not a whole lot more to go. So think about going the other way. And when you've gone up 100% in 2 years, when the average is 9% each year, that'd be 18% over 2 years. You probably don't have a whole lot of more upside in the short term. And even if you do, you're taking a massive risk to stay in and see if you get that little bit extra return. So again, this all comes back down to perspective. But I just wanted to throw history out there because you're going, and especially if we start off in April and we're not good and we have a weak April, first half of the month or whatever, you're going to be hearing all kinds of things. Oh my gosh, go away in May. We got a bear market on our hands, new lows, the volatility is spiking. A lot of those things happen when you get close to bottoms, not tops. So anyway, we're just kind of watching the action right now. I think caution remains, the key word for now, but things will improve in time. That I can almost promise you. Almost. I don't guarantee anything. All right, so let's take a look at the S&P 500, the NASDAQ. Yeah.
Let me jump in for a second, take a pause for just a second.
Okay.
A couple quick things. Number one, we got a great crowd. Give our video a like if you like this presentation. It really helps us with our algorithm. So that's really important. And the second thing, I'm getting some inquiries because on our website, maybe you can pull it up. We've got a flash sale.
Okay.
That's going on right now. And we do this every time we have an event to basically thank people for taking the time to come in here. And this is an opportunity. You're going to save a lot of money. It's our flash sale. You'll save 20% off of the cost of an annual membership, which is just a great savings. And I want to bring a couple quick things up. Number one, this will get you into Monday's event. You think this is a great event. Monday's going to be the real meat in terms of what Tom is seeing, coming up, including, some predictions that he might have for the next quarter. Also, don't forget earnings season's upon us. I can't believe it, Tom, but literally in the next week and a half, it's all going to start again. Just imagine what's going on now. Now you got the earnings season kicking in. There's going to be, I think, I wouldn't mind even a little more pullback. I think the opportunities once the selling's over and we get towards earnings going to be tremendous. Upside potential. And remember that we have 4 quarterly updates a year. This is just a very small sliver today, what you're seeing, what gets covered. Also, as an annual member, it gets you into our Market Vision event. I think it's our 6th or 7th one that'll come up next year. That alone costs as much as an annual membership. Finally, if you sign up for an annual membership today, by midnight, I'm throwing this one out here. We didn't even discuss this. I'm adding a bonus month. So if you sign up for an annual membership today, you save your 20%, plus you get another month. You just can't beat it. I just want to make sure we got that in there. You can go right to our website, the top. There's a flash sale link. Just do it. If you're ever going to do it, this is the time to do it. There's so much going to be happening between now and the end of the year. Go for it.
Yeah. Well, I think it's protection. I think we've had a tremendous, we've got a pretty good history of calling the market. I don't know that there's anyone out there that's called it better than us, especially through the pandemic and everything else that we've been through, tops and bottoms and so forth. And, we got a lot of members that we got out of the market before this last downturn. And we've gotten a lot of emails that have come in saying, thank you so much for this recent call, getting out. We even got out of our portfolios, which we had never done heading into February because I was feeling so bearish about, well, not bearish, cautious.
Right.
I'm still long-term bullish, and I keep telling everybody that I'm long-term bullish, but short-term, yes, I did feel like we had, just like we looked at on that 100-year chart, you can be in a bull market and still have these periods where you can lose a lot of money in the near term. And so I think we've been uncanny in our ability to point those out before it actually hits. And so joining us, first of all, just about all of our members are annual members to begin with. We really don't have many monthly members because we always make the price so cheap on an annual basis relative to monthly. I mean, you're going to save 50% or more. You're going to save you're probably going to save 60 or 65% using this 20% off flash sale with a 13th month than if you paid $147 a month for, the next, 12, 13 months, whatever. So I'm going to get back into all of our stuff here, but we just wanted to point out that's there on our website. If you like what we talk about, you like our approach to the market. I mean, again, if you've got somebody out there that you follow, I mean, I know some folks that have called the market pretty well. I love Larry Williams. I've met Larry. He's got kind of a similar take on the market. He might be maybe just a little bit more bullish. I don't know sometimes if he turns quite cautious enough sometimes, but we do tend to be very close. Also think Tom Lee, a lot of folks, point him out. He does a lot of videos. My problem with Tom is he's almost always bullish. He rarely is bearish. And I do think you have to keep it objective. Some people think I'm a perma bull. I'm perma bull in the sense the market almost always goes up. Look at that 100-year chart and tell me something different. But yeah, I have no problems talking about bearish, action ahead if that's what I'm seeing. So anyway, keep all that in mind. I'm going to get back over to the charts, but yeah, we wanted to make sure that everybody at least was aware of that. All right, so let's get back to that seasonality. And I'm going to try to wrap this up maybe in the next 30 minutes. I have, talked about that the fact that we record these. This is being recorded. It's live on YouTube, but we'll have recordings. So if you're not able to stick around or whatever, you still will be able to watch later and, see what you missed. So don't feel, if you got to go do something, go do it. Or if you're watching the video later, here you go. If you weren't able to watch from the beginning today. But let's take a look at some more of this historical information. So here I'm going to compare the S&P 500 to the NASDAQ 100 and just show you again over the last 13 years, this is during the secular bull market, how often the S&P 500 outperforms the NASDAQ 100. And you can see, look at these percentage of months, not very often. And when you look at the next 4 months, April, then look at May, look at July, 17% of the months over the last 12 years, 13 years, have we seen the S&P 500 move. So July is a good month for the NASDAQ. May is a great month for the NASDAQ relative to the S&P 500. So if we do see a bottom at some point, you should feel some comfort in the fact that we're probably going to see outperformance by the NASDAQ 100. It doesn't always happen in an up market, but it usually happens. Again, you got to think odds. You can't always just say this is going to happen or this isn't going to happen. You got to be at least aware of what's going on in the past, have that historical perspective, have that long-term perspective that I showed with the 100-year chart. And I think investing becomes a lot easier, especially easier than listen to all the negative stuff you're going to hear on CNBC and all these other media outlets for the next, dozens of years. I mean, it's just never going to end. There's always something negative going on. And if there's not something negative going on, you're probably topping. Let's take a look at, I wanted to show you the XLK versus the S&P 500. So this is technology ETF versus the S&P 500. We'll go back again over these last 14 or 13 years. And one thing I want to point out, and I've pointed this out to members in the past, and I've talked about it as well in some of my shows, free shows. But if you look at how technology has performed relative to the S&P 500 throughout the year, notice one thing. If you add up all the first months of each quarter, January, April, July, and October, that totals a relative gain of 1.6%. Those 4 months, if you add them together, the NASDAQ's outperformed by 1.6%. If you take the second months of calendar quarters, February, May, August, November, look at the 3 of the best performing months for technology relative to the S&P 500, and 3 of them are the second months of a quarter. That's when a lot of those technology companies are reporting. We usually get a lot of the Mag 7. We get a couple of them mid-January, 15th to the 25th. And then as we get closer to the end of January, we start getting the Apples and the Microsofts and the Amazons and, Netflix, I think, is an early one. But we start getting more of those. And then we get the second tier. Many of the software companies that are, maybe not, they don't have Microsoft stature, but they are, many billions. They could be $100 billion software company or semiconductor company. Many of those companies report in the second month of calendar quarters. And that's why you get these earnings related boosts. So this second month of every quarter, the technology group averages outperforming the S&P 500 by 4.4%. First month was only 1.6. Second month of each quarter, 4.4. And the third month of each quarter goes up only 0.9%. So the second month of each quarter is better than the other two combined, almost double the other 2 months combined. So just remember, February, May's coming up. If we have a rough April, keep it in mind. February, May, August, November, those tend to be great months for technology companies. All right, now I want to show you, let's do the XLE versus the S&P 500 energy, because gave you a little, one of the things I'm thinking about anyway is energy. And remember, energy, we went through a rough period going through the pandemic and all. There were some pretty bad months going through the pandemic. Remember, oil prices at one point went negative. They would pay you to store energy in your swimming pool if you wanted to. I mean, it was hard. It was crazy. So keep in mind that some of the numbers have been heavily impacted by that, but they also had some pretty good months rebounding on the way back up. But one thing that's been consistent is March and April. We've seen energy do really well relative to the S&P 500. March, the average gain isn't so great. It's only 0.2%, a little bit. But look at April. This is by far the best month of the year coming up, at least during the secular bull market for energy. 67% of Aprils have been higher, and the average, or higher than the S&P, not just higher. They've beaten the S&P 67%, 2/3 of the last 13 years. So it's like 8 or 9 out of 13. Then you've got the average return relative to the S&P, beating the S&P 500, 3.5%. And that's all 13 years. That's not just the ones where this includes the years where it missed and it was under the S&P. And the average outperformance is still 3.5% for April. So when I say energy looks like, it's outperforming, it's doing much better than other areas of the market, keep in mind also April tends to be a very, very strong month for energy. I'm seeing signs of more and more demand for many commodities. So I think this fits right in right now for energy. So just keep energy in mind here over the next 30 days. I think it could extend beyond that, but just again, history telling us next 30. All right, I want to move on and talk a little bit about one of the things I think, if this isn't the most important under the surface signal to watch, it's one of them. And that is the relationship between our consumer stocks. Consumer discretionary, those companies sell us the things we want. And consumer staples, those companies sell us the things we need. So what happens right before a stock market heads lower? If you're just thinking about these two, what do you think the relationship might be? Well, I can tell you that no matter how bad the stock market gets, I'm going to still buy soap. I'm going to buy toothpaste. I'm going to buy deodorant. I hope all of you feel the same way, because otherwise, I'm glad this is a virtual conference and not all of us sitting together in the same room. Be pretty bad. My point here is those products sell in any market. So, you have a downturn in the market, you have a downturn in the economy. The earnings of these types of companies, consumer staple companies, don't really get hit that hard. And they're not overpriced to begin with. It's not like Procter & Gamble, goes out and posts 100% gain in earnings year after year. Some of these technology companies certainly do. And so when they're hot, their PEs go through the roof and these stocks just take off. Well, guess what happens when the reversal happens and earnings forecasts start coming down? Those growth stocks get hammered. And what happens? Money comes out of discretionary and goes into staples. Folks, the stock market topped on February 19th, right here, right at the end of these directional lines I'm showing you. And look at what was going on right before we topped. This is a month and a half of action before we topped. Do you see staples going higher? Because I do. Do you see discretionary topping and rolling over? Because I do. And then on February 21st, I wrote an article. You can go see my article over at Stock Charts. But this was one of the most bearish days that we've seen since 2009. By my calculation, it was the 10th most bearish day in the last 16 years, February 21st. And that was because we saw discretionary stocks, the XLY, sell off all day long by like 3%. I mean, it was just straight down. There was just pure distribution. Staples went the other way, went straight up all day long. And so what's happening is you can just see the picture that Wall Street's telling us. They are getting out of discretionary at any cost, and they're pouring into the defensive groups. Why would they do that? If it's inflation, they all go down. If it's a bear market, everything's going down. But in this case, I think it's telling us the economy. It's all about the economy. Because if it's the economy, again, Staples really not going to be hurt that much. Not over time. And you can kind of see where market topped here on the 19th. We were here on Staples. Look at where we are right now. We're almost exactly where we were. We've come down quite a bit from the high, 10% on the S&P 500. Staples flat. But you can see what's happened to discretionary. Discretionary is down, I mean, from the 19th right here, that would be up around 225. We're at 197. We've dropped $28. We've dropped probably about 12%, something like that. Staples are flat. Now, the other day, look at what happened again. After we got this little rally in the market, don't you, to a lesser degree, but don't you see the exact same thing? Discretionary getting hammered throughout the day, Staples rallying. And then look what's happened since. Discretionary getting crushed, Staples just kind of going sideways. So if you're worried about the market, yeah, you should be worried about the market. I mean, this is what happens. This is exactly what happened in 2022. December of 2021, before we topped, before we had the bear market, you can go back and look at this, pull up your charts, go back and do the calculations. Staples in December 2021, Staples, consumer staples, that the XLP, that sector went up 10%. And during the same month in December, and the market went up, by the way, we set that all-time high right at the beginning of January. So while all this was happening, discretionary was the worst performing sector. It was flat, did not budge to the upside. Staples up 10%, number one. So you had the defensive part of consumer spending at the top of the sector leaderboard for December, and the discretionary companies that sell us the things that we want, new car, new house, that Starbucks latte, anything that all these specialty retailers and so forth that are in there, travel and tourism, that's discretionary. Those things were going down. The market is predicting bad things for that area that reeks of maybe not a recession, but at least a slowdown in the economy. And meanwhile, they're taking the money, not completely coming out of the market. And this is key. They're taking their money and they're reallocating it into other areas of the market, like staples, like utilities, like energy. So normally in a bear market, you're going to see a lot of this movement to the downside in all the areas eventually. Now, maybe eventually that's what we're going to see. And that would help to define whether or not we're going to eventually morph into a bear market. But right now, this sign is telling me that this is a correction. And we'll see how deep it goes. My suspicion is that we're going to go lower than we saw recently. How low and where's the bottom? We're going to be updating our members daily. I think a lot of it's going to come down to sentiment. Another big part of what we're going to talk about Monday night. And you definitely don't want to miss that, because I think sentiment is as good as anything in calling tops and bottoms. And I've been pointing out to members recently some of the things to look for in terms of sentiment. And when we start to see those things, the risk begin to shift significantly from being on the short side. You want to be on the long side when sentiment sets up properly. So again, we'll talk about that on Monday. Last thing I want to talk about, and this is something that helped me call the bottom back in 2022. I started looking at the intraday action on the QQQ. And when I say intraday action, I'm talking about how the QQQ was trading at the opening bell, how it traded in the first 30 minutes of trading, how it then traded in the next hour. So from 10 to 11, 9:30 to 10. I always call the opening gap and the morning, first half hour, especially, maybe even the first hour and a half. To me, that's all like part of amateur hour. Market makers take advantage of everybody. When the market's going down, think back to how many gap downs we had near the bottom of that 2022 bear market. We would see massive gap downs, and then we would see some rallies during the day. And then the next day, we might see a little selling during the day, and then we get another big gap down, and we see a little bit of buying later in the day. How do you think market makers accumulate shares for their institutional clients? I mean, if institutional clients want to, buy millions and millions of shares for their funds and for their clients, and I mean, you can't just put a market order in. I mean, market makers, they have clients, they have institutional clients, and their job is to execute at the best possible price for their institutional clients, their rich clients. How do you think they do that? By making us panic and get out at cheap prices. During the downtrend, I'm sure market makers are probably slowly building as everybody else is selling. That's why you see some of that afternoon rally, which is typical. I'm going to show you some things here on my Excel spreadsheet in a second. So a lot of times you'll start to see that, the afternoon buying coming in. And so in 2022, that's what we saw. We had a period at the beginning on the way down, the big move to the downside. We saw what I call pure distribution. We were down, if you looked at all the net during a period of time of all the gaps, let's say over a month, you got 21, 22 trading days. So all the gaps, if you add up all the gaps for those 21, 22 trading days, negative. How about from 9:30 to 10? I'm talking again about 2022, that first big swoosh down. How about from 9:30 to 10? The net of that period when we were going down, negative. In other words, selling. How about from 10 to 11? Negative, selling. How about 11 to 2? Negative, selling. How about 2 to 4? Last 2 hours of the day, negative, selling. That's distribution. Selling is all day long. Never stops. There's no manipulation. It's just you and me. Market makers and institutions have already, they got out. Remember, 2021, that's where we saw the rotation. They got out of what they wanted to get out of. Now it's you and me panicking over the next 6 months. And who's on the other side of those buys? I mean, there's always a buyer when you got a seller. What do market makers do? What's their primary function? Provide liquidity. So when you see these big drops, what I say, market makers go on vacation. They don't want your shares when it's just starting. When that volatility index is starting to rip to the upside, they don't want your shares. You're going to see gap downs. They want to buy your shares cheaper. How do they do that? First of all, they start with a gap down. And then they create panic because you're already down to start the day. So then retail traders go in and say, well, I can't take this anymore. I'm going to sell. And then starting around 10, maybe 11 o'clock, all of a sudden, when you're getting close to a bottom in the market, guess what? You'll start to see those other time periods later in the day start to turn up. I mean, it's all out there. You can go back and look at my videos. I think it was June 17th. If you want to go back and look at that video where I called the market bottom, that was June 17th, 2022. And if you type into YouTube my name and I'm calling the bottom, that will come up. And there'll also be another one, I think, where I said calling market bottom 2.0. And I think that was late September, right before we had that one little final puke in October. Anyhow, go back and look at it because I talked about this. I talked about manipulation. I talked about how market makers were using all of us to get shares to then sell to their institutional clients at cheap prices. They got theirs. And once they get theirs, the market can start to turn higher. We can start to see gap ups to the upside. Why? Because you and me got out of the market, and now they're going to force us to get in at higher prices. I mean, it's the same thing. It's rinse and repeat all the time in the stock market. It just gets a lot worse during bear markets or corrections. But you got to pay attention to this action. I mean, like I said, this is probably the most important, intermarket relationship that I know. Check this out. So here's a chart of the S&P 500 going back weekly since the beginning of the century, 25 years, quarter century. Look at this is the XLY versus the XLP. Basically, we went down to a low here. We went down to a low here. Here, starting to rally. We're starting to rally. Have the big drop, rally, bear market, big drop, rally back, correction. I think we had the correction. No, that was in 2023. Sorry. Moving back up, we moved to new highs. And by the way, in January, February, this ratio started going down, just like I showed you on that chart, the intraday over the last couple months. That's this coming down while the S&P was trying to go higher. Now, the reason that that's important is that normally we have positive correlation between the direction of the S&P 500 and the direction of this ratio, XLY XLP. I mean, when the XLY XLP ratio is going up, that's going to make me feel really good about the market. When it tops and starts to roll over, and especially if the S&P keeps trying to go higher, that's when I'm going to start to turn cautious. It happened again. But look at the positive correlation. Do you see how often we're anywhere from positive 0.5 to positive 1? That's the area of really strong positive correlation where the two tend to move hand in hand. Now count on your hands for me every time you see negative or inverse correlation between these two. Because as I look back, going beyond minus 0.50, I think maybe 2017, barely. And then 2002, twice, maybe right there, 2001, I don't know. Count them all. Let's add them all up. Three times in 25 years. So if you don't learn anything else from this event today, learn this. Discretionary versus staples. Think about it. That's our economy. The GDP is made up of 2/3 consumer spending. You've got to follow you've got to follow this chart. This is one of the under the surface signals that I think is one of the most important. You got to follow it. All right. 1 second. Then we're going to talk manipulation. So the first thing I'm going to do is go back. I need to unshare my screen. So just bear with me for a minute. All right. And then I will share. Hold on a second. I'm not seeing it. Should have had it up. Bear with me. I'm still trying to figure this out here. Hold on. Don't know why it's not showing, but I'm going to. All right. 1 second here. I'll share the entire screen. Hopefully this will do it. John or Tyler, if you can just let me know. Hopefully you got this Excel spreadsheet up.
Yeah, it's up.
Awesome. Okay, let's take a look. So what I did here is I'm going to start off with the QQQ. So across the bottom, you'll see all these tabs: Spider, QQQ, IWM, Apple, Microsoft, NVIDIA, Meta, Google, Amazon, Tesla, Netflix, AMD, JPM, PLTR. Of course, that's Palantir. Those are the stocks that I've started. Well, Tyler, my son, helped get me all this daily information so far in 2025, where every day, January 2nd, starting off end of last year. So I'm only looking at this right now, only I'm looking at what's happening in 2025. But we have the opening price of the QQQ on January 2nd, the 10 o'clock price, the 11 o'clock price, the 2 o'clock price, and the close. Over here, we have the difference of, what happened at the opening bell. So this $3.83 is telling us we gapped up from the close the prior day, 510.47 to 514.30. That gives us a gain of 383 on the open. And then all these others, this is the gain from, if you take the difference between 10 a.m. and the open. And then this is the gain if you take the difference between 11 a.m. and 10 a.m. This is the gain 2 p.m. minus 11 a.m. And then the close is the difference between the closing price and what we saw at 2 o'clock. So what I'm doing is I'm just breaking every day down into those time frames just to see how the QQQ is traded. And then we're doing that every day. And I actually, right before we started this, I updated it through yesterday's close. So this is right up to date. And then down here at the bottom, what I did, first of all, I did since the beginning of the year. And so what this does is it says all of the opens in 2025, if you add up all of these opens up here, there's a formula in there. You'll see the formula over there. Well, it was. Anyway, if you just add up all of these opens and come down to this, that will be the net of all the opens in 2025. This is the net of all of the action from 9:30 to 10 a.m. This is 10 a.m. to 11 a.m. This is 11 a.m. to 2 p.m. And then this is 2 p.m. to the close. Now, I want you to notice one thing that's kind of weird here is that no matter what time frame I'm looking at, 2 p.m. to the close is always positive. And I've had some folks say, well, it could be short covering. Yeah, it could be. But I can tell you when you look at options, there's not a whole lot of folks getting into put options. So I don't know why we would suspect that there's a whole lot of folks shorting. But anyway, you can break down. So this is since the beginning of the year, this row right here. And I have I put little, I'm a CPA, so I have to make these little audits. But here I added these across to see what the total was. So we dropped 41.53. Here I have the audit 41.53, and this is taking this and subtracting where we were. So it's just saying that, okay, we dropped 41.53. This is breaking it down, and this is just making sure that these two totals are the same. So it's just an audit just to make sure I haven't made a mistake. And then I do the same thing. This is since the market topped on February 19th. What's happened? And you can see what I've been calling this is just pure distribution for the most part. Well, actually, if I go down here at the bottom, you'll see it even better, I think, in this February 20th to March 13th period. So March 14th is when we started to rebound a little bit. So what I did is I just took the all-time high from the 19th close. So we started on the morning of the 20th and all the way through the 13th, which is when we hit the low close. And during that period, here is your pure distribution. Remember what I said back in early 2022, where we lost money at opens? We lost money from the 9:30 to 10 time frame. We lost money from 10 to 11. We lost money from 11 to 2, and we lost money from 2 to 4. Every period, we lost money. $71 we went down during this period, and only 4 of it was on gap downs. So we were selling during the day. It is selling, selling, selling. That is distribution. Now, where I see manipulation is where you start to see maybe on the rebounds, or even, the next time you go lower, maybe it'll be on this trip down, where you start to see most of the movement to the downside occur either on the gap or maybe in the first 30 minutes. And then you start seeing positives the rest of the day. That to me, and that's how I called the bottom. One of the reasons, that was not the only reason. That was one of the reasons I called the bottom back in June of 2022. And it's one of the things I'm looking for, quite honestly, as we go forward. Because Wall Street can't get back in without buying during the day. They can't get back in on the gaps. So we need to see buying throughout the day. So this is the QQQ. So this is just, this was since beginning of the year. This is since the market topped on February 19th through Friday's close. This is since March 3rd. We had a big down day on March 3rd. And so I went from that close to the rest of the month, just random. And then here's the breakdown. Now, if you actually look at the S&P 500 chart, you will see that January 1st to January 23rd was basically a move up. From January 24th to February 19th, the next line, that was when the market went down a little bit. Remember we had what was that, deep something from China? Remember the semiconductor that came out? That was one of the Monday mornings when we gapped down. We had the next Monday morning we gapped down, and the news was on the tariffs. Anyway, that period going from January 24th to February 19th, that was like where we went down, we gapped down, we rallied back, we went back down again, we rallied back, and then February 19th, we went just slightly higher. So this is just kind of all of that ups and downs. And this is what we saw. $21 there on the way down, on the gap down, and then we saw buying on the QQQ rest of the period. But so it wasn't until the February 20th period where we saw a lot of the distribution taking place right here. I mean, it was just pure selling, no let up. And now what I'm going to be interested in is following this to see what happens, because last 2 hours of the day over the last 2 weeks have actually been really strong. We're seeing some buying in the final 2 hours of the day. But I want to continue to follow this, because what we might see is the market go down to new lows, and this might start looking a lot more like manipulation. So this is something to keep an eye on. Now I'm going to show you, I've got 11 individual stocks here. I've got 3 index ETFs. I've got the SPDR, the QQQ, and the IWM. I'm going to show you one more. I'm going to show you Tesla. So Tesla just been beaten to a pulp, right? I'm going to focus down here on the breakdown of 2025. So remember, January 1st to January 23rd, that's when the S&P 500 went up to that initial top. During that period, you can see Tesla went up $8.50. But 7 of it was actually at the opening gap. I mean, almost all of it was the opening gap. And then we saw a lot of back and forth, saw a lot of selling in the morning, saw a little, buying back later in the day. But net, we essentially saw the gap up. The net gap ups were basically what we saw in Tesla going higher. Now, January 24th to 19th, remember, that's when the S&P was just jockeying back and forth, and we ultimately set a slightly higher high. During that period, look at the distribution that started taking place. So this was already the market moving up to a new high. And look at Tesla gapping down 19, but also selling off throughout the day. And we had a little bit of gain early in the morning, probably just to offset these huge gap downs. But we saw selling throughout the day. Then when we saw the pure distribution on the S&P 500, look at this craziness on Tesla, falling $120. Again, most of it, most periods, negative. The final 2 hours, though, during a period when Tesla lost $120, the final 2 hours, it dropped 2 cents. Or excuse me, gained 2 cents. And look at what's been happening more recently. I mean, look at March and look at the final 2 hours, gaining $4. Here was a bad day, down 3.5. Here was a bad day, down almost 3. But here's up $4, up $2.33, $2.29, $2.68, $1.29, $1.22, $14, $2.80, $1.39, $2.86, $4.12, $10.13, $1.21. I mean, Tesla's been going up into the closes. Somebody's buying it. And if you look at all of these periods that the final 2 hours are always positive. The only one that was negative was when the market was sending that final high. So you're not going to convince me that there aren't folks buying Tesla, while all the news and all the headlines scaring the heck out of folks like this is going to be the worst thing ever. Well, I think there'll be a lot of people shocked when we see where Tesla is in a year from now. That's my belief. And by the way, if you follow Larry Williams, he believes Tesla's bottomed and is already going higher. And he said it could be a massive move back to the upside. And we did see that initially. So maybe he's going to be right. I don't think we're quite there yet. I think Tesla probably will be on gap downs mostly. That's what I'm expecting. But if you start to see this and you're a short-term trader, I mean, could have made some money just simply trading Tesla in the final 2 hours. And that's been the case with a lot of stocks. Now, what I'm going to do, because I want to wrap this thing up now, what I'm going to do, this spreadsheet, when we do research like this, we provide this to our annual members. And we want to provide it to our annual members because they're making a commitment to us for a year. And so this is stuff that doesn't take, it's not, we don't do this in 2 minutes. Tyler spent a lot of time going through, putting all the information together. I've spent a lot of time trying to dissect the information, set it up in a way that's meaningful. And all of these tabs, you're going to be able to go down to the bottom and you're going to see the exact same setup. Every one of these are set up the same way. And so you can start to compare one stock versus another. Which one looks like it's still being distributed? Which one looks like maybe it's being accumulated? Follow the charts. See what the charts are telling you. Because if this starts telling you that we're seeing manipulation and that the stock might be accumulated, and you start to see it on the charts as well, and maybe get a positive divergence to form, I mean, some of these stocks could explode to the upside down the road. But what we're going to do is we're going to make this spreadsheet available to all of our annual members. So this is another bonus. If you want to take us up, and I'll bring that up one more time. But if you want to take us up on the flash sale that we mentioned earlier, now's the time to do it. I mean, you're going to get into Monday's event, first of all. And by the way, I don't know if I've shown this, but let me find a chart here. I don't know if this shows up, but when we do a market vision event, it is an event. These are all the charts that I showed back at the beginning of the year. This isn't just here's the S&P 500, here's a couple sectors. I mean, I'm going down into various industry groups. I'm talking about different sustainability ratios that I follow. I showed you all XLY XLP. There are several others. I talk about the inverted yield curve, which is now uninverting. I talk about our 10-year treasury yield versus foreign countries. The consumer price index, I get into inflation. I talk about the dollar and what's going on and the impact that the dollar will have in the market. We've got a bunch to talk about in terms of what's going on right now in foreign markets. I mean, you can see I've been in here already for an hour and a half. I mean, I could be in here for 10 hours and going over all this. Some of you probably would love it and stay every minute of it. Some of you might say, well, I do have another life out there, which I don't blame you. But my point is, we got so many there's the sentiment that I talk about. I don't know if you can see all these charts, this menu that I just pulled up, but there's probably 40 charts on here, maybe 50. I don't know. That's the in-depth we're talking about for Monday night. So that's the update we're going to give from what we talked about at the beginning of the year. And remember, beginning of the year, we said it's going to be challenging first quarter. It's going to be 10%, possibly a 10% correction. Said it before it happened. 2022, Market Vision 2022. I said it. I said the potential of a 20 to 25% drop in 6 months or less before it happened. And it's all based on using all this information I'm sharing with you today. It's not rocket science, but I'm telling you, I got really good at this when I stopped listening to CNBC and I just got all the media stuff out of my head. And again, I'm not talking about just politics. I'm talking about the way they spin everything. When you've got these big Wall Street firms that can manipulate us and they can make money off of it, do you think they wouldn't do that? I don't trust any of them, but I do trust where they're putting their money. Right on the charts. They can't hide it. Follow the charts, ignore the news. But anyway, getting back to this flash sale, part of this, we said, John came on, said he threw in an extra month. That's 13 months for the price of 12, already a 20% discount off the annual plan. We're going to have this for the next couple of days, give you some time to think about it. What you might do, even take us up on a 30-day trial and just look at our site for the next couple of days and see what we're all about. Make this decision before the event on Monday.
Yeah. Tom, I want to clarify one thing.
Yeah.
Because a few people asked in the comment section.
Yep.
What I said before was if you sign up by midnight tonight, you get a bonus month. So 13 instead of 12. I just want to make that clear. Plus, if you're already a trial member and you convert to an annual membership, whatever time you have remaining on your membership, trial membership gets added as well. So I just wanted to clear it. Plus, Aaron posted something in the comments section. You already mentioned it. These charts that you've gone over to the spreadsheets, going to go to annual members. They love those perks. And like you said, we do it because it's a commitment for a year. And so if you sign up, for this flash sales and annual membership, not only do you get the Monday's event, which is going to be awesome, everything else we do, plus the spreadsheets that we present during these webinars.
Yeah. Well, and the way I look at it, I guess everybody can decide. There's a lot of value in the education we provide throughout the year. But if you think about, what you normally would pay somebody to manage your money, I don't know, maybe what is it, 1% fee, 2%? I guess it just depends where you're going. So I kind of back into saying that if you're managing at least $50,000 on your own, whether it's your 401k, whether it's your own personal taxable, if you had somebody manage that, they're going to charge you 1% to 2%. So you're going to probably be looking. There might be some that really don't do a whole lot of trading. Maybe they charge less than that. I'm not really sure. But that our background, we are traders. I think our market guidance is exceptional for everyone, whether you're a long-term investor, a trader, or whatever. But yeah, just kind of think of it like that. If you've got money to invest, I kind of look at us as, an insurance policy, or just giving you a different look, a different perspective. And those of you that have been with us know, I don't just talk bullish. I don't just always say the market's going higher. Some people think that because in a secular bull market, that's what the market does. It mostly goes higher. But when these periods come up, 2022, 2020 in the pandemic, I didn't really see that one coming. It's pretty hard to see, but early on, you could see the volatility shooting up. The correction this year, all of this we talked about before it actually happened, or much of it. And bottoms. We're just talking about tops here, but we've called many, many bottoms. Called one recently, early March. Well, maybe it's like mid-March, maybe 13th or something. I sent out a message to members. I said, hey, I think the market is reversing here. We got options expiring coming up, probably going to be a little bit of a move up into that. And that's what we did. We took a little bit of a bounce. And then I said, okay, we got to evaluate that bounce. So we did. We got right up to resistance, couldn't get through. And you saw what happened at the end of last week. We rolled over and down we went again. And looking at that XLY XLP chart, you can see that it's not good action. When we're going back down, this is not the way we want to go back down. That's why I think we probably have another low coming. And I'll just say, I don't believe, in my opinion, I'm not going to guarantee it. I can't guarantee it. But I believe we're going to bottom shy of 20% on the S&P 500. I don't think we go 20%. And I think there are going to be ways to spot, where we get that bottom. And that's a lot of Monday's session is going to talk about how far I think we go, what to look for, exactly signals that you should be looking for to mark a bottom. That's really the critical stuff right now in the market. So take advantage of the spreadsheet, take advantage of our offer. And by the way, unless I'm hearing you wrong, John, if somebody signs up right now for a trial and then signs up under the flash sale, they get their 30-day trial and 13 months.
Yeah.
So that's 14 months.
Well, hold on.
Am I wrong?
Well, if you sign up by midnight tonight, you get a bonus month.
Oh, okay. So that's just for today. Well,
Yeah.
do the trial.
Yeah.
Look at it today and just get a sense. If you're not quite sure,
That's the way to do it.
Decision. And then, even if you decide you're going to wait a couple of days, Yeah, you don't get that extra bonus month, but you still get your trial month
Yeah,
along with the 12.
exactly.
You still get 13 months.
Yep.
Anyway, it's a great deal. Anytime we have these offers or these webinars like this, and we go out and we reach out to a lot of new folks, we do try to keep price as low as we can. I mean, the prices that folks are paying right now are the same the last 5 years. A lot of things have gone up in your life. I think we've kept our prices really reasonable through all this period. So anyhow, we'd love to have you. Again, take advantage of the sale. And if you're a current member, by the way, take advantage of the sale. If you've got, if you want to extend for 13 months, sign up today. Get your 20% discount and an extra month and extend your membership. So it's not just for new folks.
Hey, one last thing, if you're watching this, you like this video, please give it a like. That really helps our algorithm, and we appreciate everybody that came in today.
Yeah, absolutely. Just want to say thanks. I know this is, Saturday. You're taking, time out of my day, but it's certainly time out of everyone's day on the weekend. So, I think it's worth it, especially if you, have a lot at stake and you enjoy the market. I think, learning, I enjoy learning. Anything I learn I find it fascinating. I'm very passionate about the market, as you can probably tell. But yeah, I mean, it's time well spent, I think, in helping to protect your family's future. So anyway, have a great rest of your day, everybody. Thanks for coming in, and please join me on Monday. I think you're really going to enjoy it. Have a great weekend, everybody. Happy trading.